Welcome, ladies and gentlemen, to our episode 12 of the Real Estate Podcast. And as always, we tell you that it's all about exploring the dynamics in the real estate industry. It has been quite a journey, and we definitely hope that you have learned a thing or two since we began these episodes. And now, as I have said, we are in our episode 12, which we are pretty much prepared to bring you more goodies related to real estate. Victor, how are you doing?
I'm very well, Dominic. I feel rejuvenated, excited about today's topic. It's something quite important, especially for people who want to just not get real estate as a soup, but also the bones. And before you know it, we shall be having a surgeon soon who will be dissecting, will be in the real estate theater.
Agreed. We are glad that you have always come back to listen to our episodes. And as always, we will never disappoint. Wherever you are, whether you are abroad, that is diaspora, or here at home in Kenya, we will always be there to give you the right information related to real estate industry. And I will be your host, Dominic Mwangi, alongside
Victor Kiplagat.
Take us through. What are we discussing today?
Real estate investment trusts, in bracket REITs. And a real estate investment trust is a company that owns, operates, or finances income-generating real estate. These are investments that are in assets such as apartments, buildings, cell towers, data centers, hotels, medical facilities, offices, retail centers, and warehouses. The list can be endless, Dominic.
True. We can also say that a real estate investment trust is a channel that regulates the collective investments as well as enabling the contribution of resources or other consideration for the acquisition of rights or interests in a trust that is divided into units with intentions of earning profits or income from real estate. These rates are regulated by the Capital Market Authorities and the Retirement Benefit Authority, and this ensures that it is a very safe investment. Rates are comparable to bonds, except that they are pulled towards real estate development.
Real estate investment trusts are safe investment channel because they regulate and trade in public domain. And in our case, the Nairobi Stock Exchange. How do real estate investment trusts work in Kenya? The real estate investment trusts are similar to bonds, except funds are geared towards real estate development. Being an investment tool, they are regulated by the Capital Markets Authority, that is the CMA. And importantly, the return on investment on real estate investment trusts ranges between 8 and 12% per annum.
Wow.
This return investment becomes substantially considering it is compounded over the investment period. You get?
If somebody chooses to invest for 5 years, that is the period that will be used to compound.
Yeah, exactly. Real estate investment trusts allow investors to reap benefits without huge delay.
True.
A real estate investment trust must meet the following requirements. Number one, invest 75% of total assets in real estate or cash. If you don't invest like 75% of total assets in real estate or cash, it might be a development in limbo. Additionally, derive at least 75% of gross income from rents, interest on mortgages that finance real estate, property, or real estate. 75% of gross income must be from rents, interest, or mortgages. Also, pay a minimum of 90% taxable income in the form of shareholder dividends each year. And dividends are paid each year. Like you can decide either November or December or August.
Sure.
Furthermore, be an entity that is taxable as a corporation. When you're not taxable, Dominic, it means you're conducting shoddy business. Also, be managed by a board of directors or trustees. This is important. It ensures the decisions that are made are vetted by the board or the trustees, and also have at least 100 shareholders after the first year of existence. And finally, have no more than 50% of shares held by 5 or fewer individuals. The importance of this is so that you can have fairness across board.
Right. Those are some of the qualifications for a company possibly to be registered as a real estate investment trust. Am I right?
Yes, you're very right.
Exactly. Further to the types of the real estate investments trust, the major type is the income real estate Investment Trust, abbreviated as REITs. The company uses funds that are raised by the shareholders to acquire income-generating properties. These projects may include housing, commercial properties, etc., with the investors gaining through capital appreciation and the rental income. The appreciation is usually distributed to unit holders at the agreed duration. Just as Victor said, they are distributed annually at the specific set aside month. Victor, you can tell us the next type.
The next one is equity real estate investment trust. Most REITs are equity REITs which own and manage income. Also, revenues are generated primarily through rents and not by reselling properties.
Actually, I think equity real estate investment trust is almost similar to the REITs, which I explained as the type number 1.
Yes.
Because both depend majorly on the rental income that is to be shared among the shareholders. We move on to the other type of real estate investment trust, which is development real estate investment trust. This is a type of real estate investment trust where resources are pulled together for the purpose of acquiring eligible real estate for development and construction projects, and also used for acquiring land. These may include housing and commercial projects. This is where a company, Victor, pulls together the resources and uses these resources to come up with projects that are later to be changed into REITs because they will be rented out to people so that these people can now pay rental income. The Development Real Estate Investment Trust are abbreviated as D-REITs. The shareholders in D-REITs can choose to sell their units, to reinvest, or to lease out or convert these shares or their shares into income real estate investment trusts. D-REITs are also convertible into the REITs.
For the benefit of our listeners, where will you classify a mall? Which type of investment trust?
Well, a mall, you might build a mall as a real estate investment trust for the purpose of renting it out or renting out space. When it is being constructed, it will fall under development real estate investment trust. But when the project is up, the real estate investment trust can decide to convert it into income real estate investment trust.
Yeah, okay. And look at the other type of rate, and that is mortgage. Mortgage rates lend money to real estate owners and operators directly through operators and indirectly through loans. And when they acquire this mortgage, it's referred to as mortgage-backed securities. Their earnings are generated primarily by the net interest margin that is spread between the interest they earn on mortgage loans and the cost of funding these loans.
Well, there is another one. You'll find that it abides by the Sharia law. This is referred to as the Islamic Real Estate Investment Trust. It aims at allowing the investors who seek Sharia-compliant investments to invest in REITs. The investments is majorly income generating. A fund manages and ensures that non-permissible activities are not conducted in the real estate. If they are, then they are on minimal basis.
Wow. So these are, you can call it investment bound by religion. Wow. Interesting. The last type, hybrid REITs. These REITs use the investment strategy of both equity and mortgage real estate investment trust. That is the hybrid, from the word hybrid.
Now that we have known the different types, what is necessary for a company to be registered as a REITs, let's look at the advantages as well as the disadvantages. The advantages, I will quite be brief. They are exempted from double taxation. They are exempted also from corporation and income tax, except for the payment of withholding tax on interests, income, as well as the dividends. Another advantage is that there is capital access as well as access to investments. REITs facilitate pooling of savings from individuals. That is why we said there are possibly more than 100 shareholders, and this avails an opportunity, especially for the middle income class, the ability to access and own in the vast real estate industry in a manner that is less capital intensive. I was looking at a property in Kikuyu. An eighth of an acre is going for around 1.6 or 1.8 million. That is quite a lot of money for the middle income earners. So REITs are the better option. You take your 100,000, you invest in REITs where you will be reaping dividends. Another advantage is that there is liquidity of your investment. Investments in REITs, they promote liquidity of assets in such a way that the investor may sell their units in the market or avail them for redemption in case of open-ended REITs. These can be juxtaposed with the direct investments, which are generally illiquid. They promote liquidity, unlike direct investment. When you have invested in REITs, Victor, you can redeem your money. This was the period that I wanted to invest, and the period is over, as long as you had agreed it with the company earlier. But now you find that direct investment, for example, you acquire a piece of land. Before you sell this piece of land, it will take you some time. You'll have to go find a potential buyer, agree, negotiate on the price, a whole long process. Unlike now, the REITs. Another advantage is that there is higher yields and returns. REITs offer predictable income streams due to the long-term lease agreements with tenants. Hence, the rental income and the management expenses are predictable in both long and short time frames. This data is by Site on Investments, and in 2023, for example, the rental yield was at 7.7%, commercial yield was at 8.0%, and the residential yield was at 6.8%. That is within the Nairobi city. For rates, they can predict, depending on rental yield, they can predict. Last year, it was 7.7% the yield. Now this year, it can be either a little bit higher or a little bit lower. Last but not least, there is transparency. Just as we have explained, that rates are listed and traded in the Nairobi stock and security market, which makes it accessible to the public. So this assures safety of one's investments. The rates must also disclose the financial information of the respective investor on timely basis. There is professional management of REITs, because REITs avail professionals such as property managers and fund managers who are in a better position to understand the industry as well as take advantages of new opportunities. Unlike a single investor, where you go into an investment as an individual, you will need to have a lot of consultations. But now the REITs, they bring aboard property managers and fund managers who take advantage of all the opportunities in the market.
Wow, quite insightful, Dominic.
Thank you.
Disadvantages I'd like to mention very quickly. Number one, market unpredictability and potential tax hikes may affect their profitability, the profitability of real estate investment trust. And also, some REITs sometimes need to raise more funds to launch due to limited investors. Because investors are few, more funds will be required.
I'll add a few disadvantages on what you've just said. There is dividend restriction. You find that REITs are required to distribute most of their net income. Victor, you told us about 90%, right?
Yes.
So they distribute 90% of their income as dividends. This may limit their ability to reinvest capital, which may in the long run impact the growth rate of the investments. Next, you'll find that there is possible fluctuation of income. The decrease in rental income as a result of termination of lease agreements and non-renewal of lease agreements and failure to replace tenants in good time. For example, you as a REITs company, you have invested in a rental income project or rental spaces, but this month there was a termination of the lease agreements or the rental agreement with your tenants. You find that these houses or these spaces, they remain unoccupied for some time. This will affect the income that the investors or the shareholders were expecting at the end of the investment period. Finally, you find that there is competition. Competition comes from the assets in the same class, which we have explained as the treasury bills and bonds, as well as the stock.
Wow.
For all the investors who are looking for opportunities to invest, especially here in Kenya, you find that REITs is a really promising avenue because it is a new trend. It has not been exploited for quite some long time. So it is essential as well to acknowledge and address the challenges that it has, thus far limiting the proliferation of REITs. For example, the dissemination of information. You find that the information out there in the public, it's quite little. So this is a challenge that has to be dealt with so as to ensure that more people are investing in REITs. REITs is a trend that is worth embracing.
Absolutely. I'll tell our dear listener, in investing in real estate investment trust, kama sio sasa ni sasa hivi.
Agreed. And that has been our episode 12, ladies and gentlemen. And we are really thankful and grateful that you come back. We did episode 1. You came back for episode 2. You came back for episode 9. And now we are at episode 12. Thank you so much. We are really indebted.
We hope to see you when we shall be celebrating episode 100.
Thank you so much. See you in the next episode. I have been your host, Dominic Mwangi, alongside
Victor Kiplagat. Goodbye.
Goodbye.